You're scrolling through investment headlines and you hear a sound. It's not in your head. Well, actually, it is in your head. It's your fallacy alarm when somebody or something is just so full of crap, you can't take it anymore. And my guest today, Rene Bruentrup, writes a newsletter called Fallacy Alarm. He got fed up with all the nonsense, with all the post-truth investing world stuff we're dealing with, where facts and data get sidelined and emotions, personal narratives, tribalism take center stage. It doesn't make the world any better, at least Rene thinks. We have a great conversation about exactly what happens in this post-truth investing world when corporate storytelling seems to trump actual financials like earnings and revenue growth. So I think you'll like this conversation. And by the way, speaking of conversations, in April, a bunch of us here at Curia had a good roundtable conversation on video about some investment ideas, 7 investment ideas specifically. And I'm not ashamed, well, I'm a little bit ashamed to say one of my ideas, a queso bio, is already up more than 300% since we talked about it in April, at least as of today's filming. Now, most of that is luck. The vast majority of that is luck, and not all stocks do that. But if you would like to know the other 6, we're happy to give them to you. Just go to curiafinancial.com. That's CURIA financial.com. Give us your email address, and we'll send you the report. Politically speaking, it's often said that we're living in a postmodern, post-truth world, a world that doesn't go by facts, a world that's tribal, a world that maybe has forgotten or has chosen to ignore many of the traditional principles it's previously been based on. That's politically, but economically, is the same thing true? Is the investing world permanently changed? My guest today may be one of the best people to help us unpack this. His name is Rene Bruentrup, and he writes Fallacy Alarm, one of the deepest thinking, in my opinion, deepest thinking accounts on Substack there is. Rene is a true thinker in a world of doers. Rene is someone who really makes me pause and take some time to absorb what he's saying. And he's sitting across the Zoom screen from me now. So Rene, welcome.
Yeah, thank you. Thank you, James, for the kind introduction and for the invitation.
Great. So let me get a little backstory on you for someone who's just beaming into this conversation. Can you give us a bit about your background and a bit about your philosophy? I described you as a thinker in a world of doers. Is that offensive to you, or is that a compliment, or is that neutral?
I think it's pretty accurate way to describe it. I just really enjoy writing. I think it's the best way to organize my thoughts on topics that matter to me. And I think there's something beautiful in a well-crafted 2,000-word essay that answers a specific question in a structured and concise way. And so I've always been a writer, originally just for myself. But then I realized that others enjoy my writing as well when I published a few pieces as a test. And I find it very rewarding that other people find that useful, what I have to say.
Great. I've certainly found it useful. What's neat, I mean, I'm just going to shamelessly praise you. I think you're one of the smartest guys in investing. And I say that in a systematic way of thinking. I mean, some people are really, really good at math. Some people are really good at selling an idea. You're good at a lot of things. You can talk about macro. You can talk about specific stocks. You can kind of like think across the boundaries. How do you identify as an investor? Like, are you a macro guy at heart? Are you a single stock guy? Or are you a little bit of everything?
I think the beauty about being someone who manages their own money is that you can have many hats on and you can just pursue what interests you most right now. And once you have an answer to your question, then you can move on to the next topic. So I would say I'm definitely interested in macro. I think it's a very important force in investing and has become even more important over time as the role of the government in asset returns has increased. So I think understanding macro is very important. But then also I like to look into innovation platforms. I like to into single stocks. And so I just follow my nose of what interests me and also where I feel like I can something add to the debate that is differentiated or maybe even unique.
So you're kind of a non-tribal guy living in an increasingly tribal world.
Yes, yeah, that's pretty. Yeah, that's true. Yeah, it's sometimes difficult.
Yes, I bet it is. I bet it is. But I appreciate it. So let me segue to one of your recent articles on Fallacy Alarm, and we'll put a link to this in the show notes, and we'll put your website on the screen as well. Talking about momentum. Now, for those who don't know, You really give a great background in the article. Harry Markowitz, Bill Sharp, these are some of the original finance thinkers. Originally, there was the risky asset and the risk asset. It's just one or the other. Then more and more factors crept in. In the 1990s, a guy named Cliff Asness, who was known for having a very hot temper, incidentally, did some research on momentum. And really, since the great financial crisis, we've had increasing amounts of momentum, especially the past couple of years. And I'm forgetting some of the stats that you shared, but it's just amazing the contribution of momentum to market returns. Without my rambling any further, in your words, Rene, how do we get here?
Yeah, so I think it's two topics that are not necessarily immediately connected for people, but there is a connection if you think a little bit more about it. So back in the 1980s, it started becoming common knowledge that passive investing has a positive expected return that exceeds the return that you can get on your savings in treasuries. Yeah, the famous equity risk premium. And yeah, there were people like Markowitz who had already studied this like 30 years ago, but it took actually a long time for the general public to sink in with that consensus. And so when it did sink in, then people started buying ETFs, and the first was obviously John Bogle with Vanguard, but then more and more this succeeded in the stock market, and because people realized they don't need to pay a fund manager to participate in the stock market, they can just buy the entire market and free ride the price discovery provided by analysts, fund managers, and so on.
Yeah, especially if 90% of active fund managers underperform over 10 years,
Exactly.
or whatever the stat is.
Yeah, you can buy the SPY, famous ETF on the S&P 500, and you will probably be better off than most of the fund managers out there. And that's a pretty compelling selling point for this product. And that's why it has increased massively in size over the last 30 years. So globally, 50% of all funds are now in ETF in passive mandates, and in the US, it's even 60% of the share. And so in the last 18 months alone, mutual funds have lost $1 trillion to ETFs, and most of these ETFs follow passive mandates or pretty much passive mandates, sort of. Some are maybe a little bit more algorithmic in their nature, but most of them are passive or very, very simple buying and selling rules. And it's a huge asset rotation. It's still accelerating. It seems like it. And I think so far it hasn't been a problem. But the bigger this gets, the bigger the problem becomes. Because when you don't have passive players in the market, you have natural mechanisms that bring back price excesses. So if a stock, for example, runs too much compared to its fundamentals, then at some point it will just simply run out of buyers because investors will think it's too expensive for the cash flows they receive in return. And passive mandates are completely valuation indifferent. So as long as the liquidity tap is open, which is in our days mostly government deficit spending, these deficit flows, they just keep buying the market at any price. And every day this passive bid shows up, it validates yesterday's price, and the rally can continue. And so that is the link between the passive boom and the huge outperformance of the momentum factor that we have seen recently, because people just can generate alpha by just adding to their winners and cutting their losers. And in the last 15 years, this factor has outperformed by 3% on a volatility adjusted basis, which is huge.
It's
if
huge.
You think about for 15 years, 3% every year with no additional volatility, it's a dream result for any fund manager, and you could have achieved that without performing any fundamental.
Not doing any work, really. Yeah.
So it's a devastating reality for the entire asset management industry if you think about it, and it has accelerated over the last, let's say, 1 or 2 years. The annual outperformance of this factor is more than 10%, and so these two things are, in my opinion, clearly related, and it seems like we are hitting sort of a limit in regards of how much this market can absorb these massive passive flows.
So let me present, if I'm trying to be a devil's advocate here, I could think of two things. And when you think of momentum, maybe the average person thinks of retail investors piling into Nvidia or some hot stock. And you're saying it's not, that's the smaller factor here. Probably the bigger factor is just money coming into the market, money coming into passive funds. Now, in terms of the devil's advocate perspective, one could argue that if this is just people waking up and saying, hey, the stock market is a good way to build wealth, I'm just going to put money in and just sit on it. Like, if that factor doesn't change, it's just sort of a permanent addition to money in the market, which is probably good. Yeah, it's weird for now, but it's good. What the risk is, if that is that money bailing, that money deciding, let's leave the market. These valuations are unsustainable. Do you agree with that? And if so, how do you measure that risk of the money leaving and then stocks going down?
Yeah, so I think there are a couple of responses. I think they are interesting here. The one thing is, why is the whole meme stock boom happening at the same time as the passive boom is sort of escalating? And the way I think about it is, the passive flow creates an environment where momentum outperforms, because the passive bid ensures that momentum can continue and won't be brought back to a mean reversion soon enough. And so that creates an environment where momentum outperforms. And then you have people or executives that have an ability for storytelling. They can generate momentum. So basically, as an executive in this environment,
Mm-hmm.
you don't just need to grow your earnings, you also need to tell a story to create momentum in your share price, because that alone can already create a competitive advantage for you. It lowers your cost of capital, and then you can use that as an advantage against other companies. And retail investors are typically more willing to buy into those narratives, because I don't think they have this the pride that let's say an institutional investor has, who then looks at fundamentals that don't make sense to him, and then they bet against it and get eaten alive in the last, let's say, 1 or 2 years. So that's the connection there. I think that connects the whole meme stock phenomenon to this.
It's almost like a barbell or opposite extreme strategy. The most passive form of investing is fueling one of the most active forms of investing at the same time, you're saying.
Yeah, you could frame it that way. It's interesting, and I don't think it's coincidence that it's happening at the same time. The second question that you had then was, how can this end? And I mean, so far, it doesn't show any signs of ending. Usually, you would say, if in the stock market most people are doing the same thing, it should stop working. And there are even people who say that, you could have an outperformance again of active investing, because you will see this huge overvaluation in everything that is in these passive mandates, and you can then buy other things that are uncovered through market inefficiency. Uh, but so far, we're not seeing any of that, right? It's
Mm-hmm.
crazy. It just keeps going and going and going, and it's a cycle that feeds itself, and just it keeps going, and it's definitely a challenge to think about how this can unravel at some point.
Yeah, it's interesting. I've seen some articles in Wall Street Journal about how some of the retail investors have read the Warren Buffett stuff, the value investing stuff so much that they're happy to jump in and buy any dips. There could be an argument that this time is permanently different in the sense that we have a more robust market than we've had before. We have more focus on intangibles instead of fixed assets, which are more expensive. There are probably three or four reasons you could make that valuations should be permanently higher than they were in the past. We may not revert to a 15 PE in the US market, for example. Do you buy that, or do you think that's just people trying to explain away a bubble?
Um, I think there are good reasons for higher valuations than in the past. So, for example, if you think about what should a market or any asset be worth, I think it's a question. It's a function of the cost of capital, and then it's a function of the growth rate. And I think the cost of capital has probably come down simply because there's so much more market participation. 50 years ago, people just bought treasury securities. Today, they're buying the stock market. So you have more money chasing these assets because there's a realization that you can earn more if you can bear the volatility. So I can see that argument. However, with respect to the growth rate, I covered that in another article that I believe we have seen the US stock market re-rate from a low growth and low interest rate environment to a higher growth and higher interest rate environment over the last 3 to 4 years, simply because deficit spending has accelerated and interestingly doesn't come down. So after the great financial crisis, we had a huge jump in deficit spending, but then it came down a lot to much more reasonable levels. But now we have seen this reacceleration again in deficit spending, and we are at like 6, 7, 8% deficit to GDP due outside of a recession. I think that's unprecedented, and that at the moment fuels the economic growth in the US, which has grown at a rate faster than it has grown in the early 2000s when we built up to the great financial crisis. And so that also, in my opinion, has contributed to this huge stock market boom. And whether that can be sustainable, I have my doubts personally.
Do you think either passive investing, or you mentioned its cousin, some kind of rules-based ETF, maybe not be totally passive, but somewhat in that spirit, could that be planting the seeds of destruction eventually in U.S. markets? Because if you imagine a market with no passive investing, you've got great price discovery. Because as an investor, you could be rewarded for finding some problem or noticing some good thing about a stock that other people don't yet notice, but maybe will notice soon. But if you're buying, if the rule of going up, if you're a company, is whether or not you're included in an ETF. Maybe it's a simple S&P 500 ETF. Maybe it's something more aggressive. Maybe it's the stocks under $10 a share ETF, which we'll probably have one day, right? I mean, there's so many, probably more ETFs than stocks now, or roughly the same. I don't know the number, but I guess my point is even a more active ETF is still much less discriminating than a true active investor. So is that making the market dumber? Is that making the market less predictable? And is that ultimately making the market less valuable?
Yeah, so I think if you had asked me this question a couple of years ago, I would have told you that there's no evidence for any of that, and there's still enough trading going on, and stock market returns have been great. And even like someone like Warren Buffett is a huge fan of passive mandates. But lately, given that we have seen so many excesses, and in my opinion, of the assets that I pay close attention to, there are ridiculous price excesses there. I feel like this is becoming a problem, if let's say if you think this all the way till the end, the most extreme scenario, 100% of the money in passive mandates, they just buy the market every time the government spends $1 of deficit. It ripples through the economy and then buys the S&P 500 at the end of that chain. Then corporate earnings won't matter anymore, right?
Mm-hmm.
It won't matter anymore whether any company invests into projects which with a decent return on investment, right? Like even today, nobody is really asking whether the big tech companies will have a positive return on investment with all their big data center built out. Like nobody knows that, right? Maybe they will, but it's a huge gamble. They're investing hundreds of billions per year, and nobody knows what the return on investment on that will ultimately be. So I think there is a risk here that this dumb algorithm will over time cause misallocations of capital, because historically the US stock market has been amazing in directing capital to the most productive projects. And if that gets impaired because nobody's really looking anymore fundamentally justify at best projects because it's just narrative and just surfing the liquidity, then I think there could be a negative surprise to economic growth in the future. And at some point, I still believe that fundamentals will matter and that this will manifest itself in wealth destruction.
It sounds very scary.
Yeah.
Speaking of
But
narratives,
it's an extreme scenario, right? I think we're still
well,
far
no,
away from 100%.
yeah, but it certainly could happen, right? I mean, if there are no rewards to being a smart investor, no rewards to finding good stocks, to being discriminating, to doing deep research, then who's going to do them? And maybe companies don't care either. They focus their efforts instead of on good accounting and instead of good investor relations on telling good stories. It could happen, right?
It could happen. I think it's helpful to think in these extremes, not because I predict them to happen, but in order to understand the underlying mechanics and the direction where we're going. Yeah.
So speaking of stories, I just want to ask you about gambling and investing. If Rene and I started the Rene and James fundamental ETF, we'd probably get $6 in capital raised. If we started the 5x NVIDIA daily zero data expiration options, whatever, we would have tons of money. I'm guessing we would.
Probably.
My question is this: it seems like gambling and investing are they've never been completely separate. There's always been an element of gambling in the stock market by risky day traders, things like that. But it seems like that element, the fun element, is growing now. We've got the tools; it's just easier. All else equal, if you have the same expected value, the one that has the smaller dispersion of potential returns is the more predictable one is more valuable. In other words, like volatility, unless you're talking about stock options, volatility reduces expected value. So it would seem like gambling would increase the volatility. Do you think that's a meaningful concern? And if you were to fast forward 10, 15, 20 years, what do you think equity markets look like in terms of gambling versus passive versus active?
It's. I think if to the extent that gambling replaces investing, certainly I believe that the expected return has to go lower. If you think about a lottery ticket that has an expected return of minus 100% and an expected volatility of indefinite, right? Because in 99.99% of the cases you get nothing, but in the one case where you get a million, that blows out all the volatility, right? And actually, maybe we can later on, I can share a graph with you. I don't have it ready for this conversation right now, but I did actually perform an analysis on the relationship between volatility and return. Because yes, traditional finance says it needs to be positively correlated. The more volatility you bear as an investor, the higher your expected return will go, right? But at some point, there's a tipping point where this doesn't work anymore. And in the most extreme case is a lottery ticket. Yeah. So you have to think about the sort of the line on the volatility to return chart is more like a slope like this. And the most volatile ETFs, think about a leveraged there are leveraged ETFs, for example, on natural gas or on the VIX. Or leverage ETFs on the Chinese stock market, they have terrible long-term returns because of that reason, because they attract gamblers who then employ leverage. And the more leverage you employ in investing, the higher the cost of that leverage will be. So I believe if the US stock market degenerates into a gambling vehicle, certainly the long-term return has to come down. And you can see it in China, by the way. If you look at the Chinese stock market, it looks terrible on a long-term chart, always with these spikes and then followed by long periods of consolidation. It's by no means a perfect parabola like the US stock market. Or you look at Japan, what they experienced in the 1980s, took them decades to recover from that. And I think they also had a gambling Japanese investing in the 1980s had also an aspect of gambling to it. And so that is a problem. And maybe, I don't know, but it could be possible that the strong returns that we're seeing right now and the excessive valuations that we're seeing right now maybe that prepares lower returns in the future. Could be.
Interesting. Yeah, well, we'll see. Yeah, and with these leveraged ETFs, I did some research on these years ago. Technically, if the underlying asset keeps going up, they can make a lot of money. But if it's down, or if it's even flat, you get killed, because they're basically buying high and then selling even higher, buying high or selling low. As the stock goes up, they have to reset their hedges every single day, which gets very, very expensive. So you're
And
right.
that's why they are like a 2 times leverage ETF. People think about it as if it's a passive mandate, but it's an algorithm, because you cannot have constant 2 times leverage, because then you will, if it drops by 100%, you're wiped out, right? So this thing has to buy every day it rises and sell every time it falls. So
Yep.
to keep the leverage constant, it has to constantly do a momentum bet, right?
Yep.
And that of course works in this market. You look at these leverage, even 3 times leveraged ETFs on the S&P or on the Nasdaq, they have performed extremely well. But the moment the volatility is too high versus the return, you have a wipeout in these products, which you can see in the Chinese counterparts, for example, of these ETFs. And I have no doubt, or it's difficult to have no doubt about something in these days, but something like the MicroStrategy Cosmos, for example, which is leverage stacked on leverage stacked on leverage, right? Bitcoin is a leverage bet on liquidity on the stock market. Then you have MicroStrategy as a leverage bet on that. Then you have MicroStrategy's derivatives, and they have derivatives on top of that. These are huge momentum structures that are very vulnerable should this theme ever unravel.
So to make quick money, we just need to make the leveraged ETF that bets on other leveraged ETFs
Yeah.
on MicroStrategy.
Yeah,
Which works until someone does it on us.
It keeps working, and people like us just have to look at it from the sidelines in complete perplexity. And yeah,
So let me shift gears, Rene. Humanity's progress and exponential returns. I want to talk about this. I don't know if leveraged ETFs are considered progress for humanity, but in general, humanity makes progress over time. We've gotten better in medicines, for example. One example I like to cite is fighting cancer. You could argue that we've made more progress fighting cancer in the past 10 years or so than in the past 100 or even 1,000 years before that, right? Certain things have just gotten better parabolically. Does that argument extend to the stock market? Is there just more value being added? First with technology, electronics, your industrial age, let's say 100 years ago, 120 years ago, 130 years ago. Then we had just better communications, the transistor radio. We had eventually internet. Now we have AI. I mean, computers and internet and AI. Is the world just getting more valuable? And is that another reason that all these stocks that seem to be crazy valuation wise are actually not so crazy?
this again a question that I would probably have answered differently if you asked me 1 or 2 years ago, because we had all these recession fears in 2023, and people were afraid about rising interest rates causing a recession. And they always argued these interest rates work differently with a lot when there's a lot of government debt out there compared to when there's not a lot of government debt out there, because an interest payment from the government is always a savings injection for the private sector, and then
Yep.
you actually have the growth accelerating from that counterintuitively. And so at that time, I feel like it, with that argument exactly, you could just be optimistic and argue there is a lot of pessimism out there, and we can just climb this wall of worry that we have been climbing for, let's say, the last 200 years, because it has been amazing, right? Uh, and at some point I will probably again say yes to this. It's just at this point I think something broke for me in December of last year, where I felt like this cannot be right the way this is operating, and and we will have to have some sort of consolidation again before, like we have to we have to. It's kind of a fever that we have to shake out. That's my opinion, and I think even if I'm not even if I'm not correct and it will just continue like this, it's also very difficult for someone with my approach to invest in a market like this. So I don't know. I may sound a lot like a doomer in this conversation, which is actually not at all my nature. Because if someone read, let's say, all these hundreds of articles that I have written over the last years, many of them were very optimistic articles and argued for all these things that you have just laid out. It's just that at this point, I'm just very uncomfortable with a lot of things. And one thing that is also, I think, worth pointing out is yes, there is an exponential growth in the progress of humanity, but there's also volatility to it, right?
Yeah.
And if you think about a guy from 1,000 years living today, you'd be shocked in what kind of heaven we live. But if you then go another 1,000 years back, a Roman who lived in Rome 2,000 years ago, if you put him into a medieval village in Germany 1,000 years later, you'd probably be shocked at the living conditions. So there is a lot of volatility to this too. We should not take everything for granted. This volatility periods of consolidation can last a human lifetime or more, and there's always a risk that we need to be aware of, and that risk has to have a price. And I feel like at the moment we're not pricing risk appropriately.
Yeah, I mean, the way I agree with that, and you know, obviously, I'm interviewing you, but just for my 2 cents on that, if you behind every investment decision, there's a why, right? Why is somebody buying? Why is somebody selling? And if you look at the qualities of the whys out there across the whole market, I tend to think they're probably lower quality whys than in some prior years or prior generations, which does embed some element of risk. Speaking of this kind of stuff, the progress not being either linear or at least a smooth parabola, if I'm just curious, and I don't want to get, this is a potentially big topic, so maybe I'll try to be quick about it, but currencies have traditionally only lasted for so long, right? The US, the dollar, it's been the global reserve currency for quite a while. It's gone down, gone back up a little bit now. The U.S.'s credibility has obviously been affected, has arguably been affected on the global stage. A lot of people criticize the U.S. for having a lot of debt. What do you make of the overall economic climate? Are you more positive or are you more negative?
Um, I think the US has all the ingredients to continue to be the dominant country in the world that it has been for the last 100 years. They are riding all the innovation waves that are out there, especially AI, of course, but also in other areas. They have huge energy resources. The cost of energy in the US is very low compared to Europe, for example, or other developed countries. That allows for a huge competitive advantage of the companies, the domestic companies. The military force, of course, the cultural dominance, the immigration strategy. The US attracts the greatest talents in pretty much all important fields. Uh, whenever something new happens, like it will happen in the Silicon Valley, not necessarily because the guy who is developing that is originally from the Silicon Valley, but they go to the Silicon Valley to pitch their idea, and there you can get the capital to get it done.
Yeah.
And so structurally, I would say I'm still a huge bull for the US. What I'm a bit irritated about is, and I don't want to make this political, and I actually have also a lot of sympathies for the conservative movement in the US. But what irritates me a little bit is, for example, how the whole trade topic is being approached. In my opinion, the US has been a huge winner in international trade over the last decades. And you can see that in the development of incomes. Yeah? Like 15 years ago, Canadians and Americans had the same GDP per capita. Today, Canada is at maybe almost half or 60% of
Wow.
GDP per capita, right?
Wow.
It's a huge, and the spread to European countries and Japan and so on is probably even bigger. And why is that? Because the US has benefited from these trade deficits. Trade deficits are capital imports. There's no other way how a foreigner can invest capital in the US without first giving Americans goods and services. That's how you acquire the dollars you need to invest in the US. So every time the US runs a trade deficit, they get capital from abroad invested in their country. And you could, of course, argue that over time this will sell out the US economy, but that's not true as long as the residual grows more. And I think that has been the case. I think foreigners have invested in the US, they have grown the US economy, and the overall US economy, excluding the share owned by foreigners, is higher today than it would have been without the international trade. Like
Yeah.
all of this has pumped capital in the US. Export nations, it's very easy to run an export model for the politicians because you can very easily control for unemployment, for example. It's also easier to control for inflation, but you're constantly draining the domestic economy of capital, right? Some people in your country will get rich by building claims on foreign assets, but overall the economy will starve of capital. And the US has managed to convert capital inflows into higher growth. And that's the huge strength of the US economy, the ability to convert capital into profits. And I feel like this is being given away right now based on an ideology that argues every trade deficit is a national disgrace. And that I find highly problematic. So the US has everything it needs to continue to succeed, but I feel like out of pride, it's kind of jeopardizing that right now.
There are unfair trade practices and there's trade deficits. They're two totally separate things, right? I have a trade deficit with my local supermarket
Yeah,
because I buy more than they buy from me, right? But
yeah,
there's nothing wrong with that. That's the
yeah.
normal way of things, right? So I think I agree. I think we're conflating the two when they're totally distinct concepts.
Yeah, you buy from the grocery store your milk so that you don't have to have a cow in your garage to make the milk for you and spend the time milking it. So you can use the time you would use for milking the cow to make money with other endeavors, and overall you will be richer, right? And I think it's a very good example.
I'd rather be reading Fallacy Alarm than milking my cow. Exactly.
Yeah.
Quick question, Ray, on Europe, because that's where you're from, and you may have special knowledge. A couple of my investor friends have been big on Europe, whether just European defense stocks or European stocks overall. How do you feel about that trade?
So I think there is a lot to be excited about because I believe that Europe has suffered much more from the Ukraine war than we appreciate for the most part, especially the energy costs have completely
Hmm.
exploded. And if at some point, right now, unfortunately, it doesn't look that way, but if at some point Germany, for example, brought Russian gas again, it would be a huge help for the German economy. So there is a lot of upside from that perspective. What I'm a bit concerned about is I'm a huge fan of the Bank of America Fund Manager Survey. Actually, I cover it every month in my monthly market report. And this fund manager survey surveys $600 billion of capital investors that represent that amount of capital, and it asks them every month how much exposure do you have to every asset class, geographical asset classes, sectors, and so on. And they are heavy in Europe, heavily invested
Hmm.
in Europe, and more often than not in the past, that has been a counter um, signal because they are often weak hands.
Yep.
Not every one of them individually, but in some, they represent a huge amount of capital, especially in a passive world where the actually active capital that performs price discovery is much smaller, and they are heavy on Europe. So I feel like it's difficult in that environment for Europe to outperform in the near term. It's of course not unthinkable. There can be other factors at play, but that's something that makes me very concerned about it, and that makes me not feel much of urgency to look into it myself.
Yeah, investing is a social science. It's all about relative expectations, and Europe has a lot of expectations right now. So, Rene, as we start to wrap up, pretend you've got a young person, maybe coming out of a university, has a little bit of money to invest, just trying to make sense of things. Two questions. What would you tell that young person is something that most people are misunderstanding about the markets right now? And it could have been one of the things we discussed already. I hear some of your frustrations. And just generally, what kind of suggestions or advice? It could be things to do, areas to look at, a company that you like, company you don't like. What kind of advice would you give that person?
I would say read Fallacy Alarm. just, just kidding. Um, I think I would recommend to have patience in developing what works emotionally for you. I think there are many ways to invest successfully, but only a few that work for everyone on a psychological level. And the best investment can fail working for you if you sell and buy at the worst times. So pick an approach that works for you, where you feel like you understand it better than other people, and then just take your time to find it. And you don't need to worry that all good opportunities will be gone tomorrow if you don't grab them today. There will always be opportunities coming up. That's actually the beauty about investing in public markets, that new opportunities come your way all the time. So you can take your time. You don't have to feel the pressure, and yeah, develop then an approach that works for you. I would say that's probably the most, at the most general level, what I would say.
Very good advice. And in terms of like one thing the market is missing or misunderstanding, what would you say?
Um, I think it's today. It's very attractive to buy into the narrative of endless deficit spending, and the consequences that come with it for asset prices, crypto, and so on. The entire crypto universe is built on the idea of 6, 7, 8% deficit spending. I would advise not to take that as something structural that will continue forever. I think deficit spending is very unpopular. Many people believe they do not participate in its benefits, and even those who do, who have gained a lot on paper, don't like it. So I wouldn't be surprised if we see a pendulum swing back into another direction soon, and tariffs may be something that can be a catalyst to make that happen. So I would be cautious about that. I would be cautious about just discounting the U.S. government's willingness to reduce the deficit spending.
Rene, if somebody's watching this saying, I like this guy, he has the tribe of no tribe, and that feels like my tribe. Where can I go to learn more about him? Where can I go to find Fallacy Alarm? And we'll put the website on the screen, but
Yeah.
where else would you send that person?
Yeah, so fallacyalarm.com, obviously, I write about 1 to 2 emails per week, and about half of them is completely without paywall. And yeah, every article I'm just trying to answer a question that I've been pondering about, whether it's macro or single stocks or industries. I'm also pretty busy on X with the same handle, Fallacy Alarm. And yeah, that's basically where you can find me. And if you read anything and you like it a lot or you dislike it, just send me a message. It has actually happened quite often that exchanges with readers have prompted new articles for me, because it's very helpful to get the feedback.
Yeah, content is interactive these days, and there's a lot of you get some weirdos, but mostly good people who care, and that's a great benefit of modern life, I would say. Rene, you are a deep thinker, a systemic thinker, and I just wish we had more of you in the investing world. It's been a pleasure to sit here and chat with you for this time. Really appreciate your insights. Hope we can do this again. So thanks to you, and thanks to you guys for watching us at home.
Thank you, James.
Hi again, guys. Before you head out, if you liked Rene's content as much as I did, or even half as much as I did, do me a favor and hit subscribe wherever you're listening to this or watching this, and jump over to curiafinancial.com. That's CURIA financial.com, where you can subscribe to our free regular email Curia Digest. We got lots of stock ideas, lots of special guts, lots of good stuff for you. CuriaFinancial.com.